Welcome to episode 2 of the Retire Ready podcast, the podcast that helps Canadians prepare for all that retirement brings. I am your host, Scott Sather, founder, president, and financial planner at Awaken Wealth Management and portfolio manager with Awaken Investments of Align Capital Partners in Regina, Saskatchewan. Today's episode is part 1 of a 3-part series on financial advisors. Today, we're going to talk about if you really need a financial advisor or planner, and if so, why and what value an advisor provides. So for the sake of simplicity, I'm going to be saying financial advisor throughout the show, but really I should be saying financial planner, as there is a difference in the two titles, but we'll get to that in part 2. And for that matter, I should also be using the word real in front of both of these titles, as a real financial advisor or a real financial planner is who you would actually want to work with. But we'll talk through what that means and the differences between them in this episode and the episodes to come. The goal is to be able to summarize these episodes into a white paper and a checklist that you can use when looking for an advisor. So you'll be able to visit awakenwealth.ca and download these documents that will talk about the various things we're about to talk about over the next couple of episodes. These will be available on the site at the end of the series, so keep an eye out for that. Now, you might be asking, why are we talking about financial advisors on a retirement podcast? Well, a lot of people come to advisors when planning for retirement. I would go so far as to say the vast majority of Canadians look to talk to an advisor about retirement planning. And so I think you need to be prepared on how to find the right advisor for you, making sure that person understands your situation and your goals. This also comes from over the last 2 or 3 years seeing posts on social media, folks reaching out on Facebook or Twitter looking for recommendations from their friends or just those in the local community on who good advisors are. And well-meaning people giving out names of their advisor or advisors that they know of as a recommendation, many of which, though, are more salespeople than financial advisors. Because a lot of advisors in today's day and age here in Canada, not all of them, mind you, but a great number of them are just glorified salespeople. They're out there to sell a product, get a commission, and move on to the next person or sale. They don't take the time to get to know you or your situation, your goals. They don't do any real planning. They come in with a product that they're looking to sell. They are transactional, and while that may be better than nothing, most people deserve better. Many of these salespeople are focusing on high-cost products, or they're only offering one type of solution, so people aren't getting what's best for them. So I really wanted to help folks to be able to make a more educated decision on what to look for when it comes to the search for a real financial advisor. So the first question, do you need a financial advisor? Now, I should start by saying I am a financial advisor, financial planner, and honestly, I believe that I am one of those real financial planners. So obviously, I might be a little bit biased, but from my experience with over 25 years in the financial services industry, I would say most, and if I had to put a number to it, I would say 95% of Canadians would benefit from working with a real financial advisor. That's net of the cost of hiring the advisor, as there is typically a cost, whether you see it or not, as most people don't work for free. From what I've seen, people need someone there that's going to guide them to be that third party that can provide advice and help them steer away from making bad money decisions. And I have seen way too often where people have made financial decisions that have hurt both their current situation and future. Cases where if there was some sort of barrier there, that being an advisor, they probably wouldn't have made the decision. Someone there to be able to say, hey, here's the consequences of making that decision. Are you sure you want to still do this? I can think of a number of examples offhand from conversations I've had with clients or acquaintances, both at that time or after. The first one that kind of comes to mind was back in my banking days during the 2000 to 2003 bear market. I had made the change from working with a big global brokerage firm to back with the bank due to honestly not making enough money for us as a family. I was too young, and it was definitely an interesting time in the markets, but that's a story for a different episode. Now, I had gone back to the bank and had some folks come in to see me as their investments were down in value. They hadn't been invested very long, but they just wanted out. They were scared. We were in the middle to end of the bear market, and it was the first time in a while where we saw negative returns over a few years. Now, I knew getting out was not the best thing for them, but it would make them feel better. I shared some of the limited resources I had at my hands at that time as to why this was the worst decision they could make, but there wasn't much I could do to stop them. And really, the decision was theirs. I wasn't working as a real advisor, but more of a glorified order taker. Providing advice was very limited. Now, again, they were scared. They had been put into a portfolio with more risk than they were comfortable with, and they were never educated on the volatility that they might see. At the end of the day, they ended up pulling out the money and moving their money to a GIC. I was able to at least get some of the money into an index-linked GIC. Again, not the best solution, but at least something that would give them some exposure to the market while limiting the downside, and hopefully help gain some of those losses back when the market would come back up, which it of course did. Now, most of the time, we like telling people about the winners, the times we've made money investing. But I've also had a number of folks throughout the years tell me about changes they made on their own to their investments or pensions by increasing risk when times were good or reducing risk when markets got rough. Again, making more emotionally driven decisions, but essentially timing the markets at the wrong times. Places where, had an advisor been there, they could have helped show how actions like these in past events would have ended up. Two offhand were a few folks that increased their equity exposure past the recommended asset allocation, where they should have been invested when things were good. Just because they saw others making more money, they wanted to jump in. Now, this was right before 2008, only to feel the great financial recession that much more because they'd increased that exposure to it. The other one being during the beginning of COVID. Markets fell fairly quickly at the news of the pandemic, but rallied quickly as well to make up the losses. Again, this was close to the same story as before. Folks got nervous, decided to move their pension to cash and wait things out, only to be on the sidelines watching as the markets came back up. These are just a few memories that come to mind, but there's many stories we could tell. Okay, so after all that, I'm still not sure I've answered the questions. Do you need an advisor? I think to help answer that, we need to first answer what value does an advisor truly bring to the table. Historically, most people would hire an advisor to pick winning investments, whether that be managing a portfolio of stocks or picking the best managers out there in a mutual fund. That was the advisor's perceived value. But the evidence proves that realistically, neither of these add much value in comparison to what you're paying for. All you have to do is look at the S&P Indices versus Active report, otherwise known as SPIVA. For here in Canada, you could look at the US or many of the international markets as well, and you see that most managers, after fees, underperform their index. So then where does the value come from? Thankfully, we do have some research that speaks to where an advisor provides value. We have research from a number of places, but we're going to talk about some of the articles and research from Vanguard and Russell Investments specifically that talk to where an advisor's value comes from and even quantifies how much in a percentage terms an advisor could provide. Vanguard study talks about portfolio construction, wealth management, and behavioral coaching being the three pillars an advisor adds value. Whereas Russell uses the formula A plus B plus C plus T, meaning active rebalancing plus behavioral coaching plus customized experience and family wealth planning plus tax smart planning and investing. That's where they see an advisor adds value. Vanguard's research in their Advisor Alpha study has stated an advisor can provide up to 3% or higher of value, while Russell's value of an advisor had said that for Canadians, that number was higher at 3.85%. And I'll include links to these articles in the show notes. So on the investment front, an advisor can provide value, but not so much in what we've previously mentioned, but instead by focusing on finding and recommending low-cost, evidence-based solutions and strategies, like mutual funds and exchange-traded funds, or ETFs. And yes, mutual funds, despite their bad reputation, which many have earned due to the high fees and active management approach, mutual funds can be low cost and can be the best solution. So advisors recommending these types of investments and applying your risk tolerance to your portfolio through asset allocation and rebalancing using asset location. That means where different asset classes are held in different accounts to minimize taxes, focusing on total return instead of income investing. These are the places an advisor adds value on the investment front. Vanguard has quantified the portfolio construction provided by an advisor, that value being in the range of 86 to 128 basis points. So that's 0.86% to 1.28%, with a lot of that coming from advisors focusing on lower cost products or solutions. So right there is where we see the real financial advisor come out. While the index or evidence-based funds and ETFs have the cost advantage, those advisors believing in active strategies can still find lower cost options. And at the end of the day, despite some saying fees don't matter, they do. It's the simple math of investing. As Vanguard founder Jack Bogle says in his book, The Little Book of Common Sense Investing, the more the managers take, the less the investors make. Where an advisor truly adds value is by knowing their clients through meaningful conversations and meetings, then going through the planning process, and then helping them to make a good financial decision by sticking to the plan or making adjustments as needed. Think of it along the lines of going in to see your doctor. You hopefully don't go into your doctor and say, "Hey, doc, something's wrong," and instantly walk out with a prescription. No, you want a thorough diagnosis. Ideally, the physician takes the time to know you and your situation, or already does through years of already meeting. They have some background on you and your family's health history. They then look at some tests or analysis to help them make a diagnosis and are then able to prescribe a remedy. The same idea applies to a real financial advisor. They shouldn't just be selling you a product, especially in the first meeting, and even more so without putting a plan together as to why the product or solution makes sense. This salesperson mentality is what's given advisors a bad reputation in the past, and unfortunately is what many Canadians still experience today. So planning is another way an advisor provides value. Notice how I said planning and not a financial plan. Now, there's definitely value in the financial plan, but the true value comes in the process of planning that leads to the plan. Usually the actual physical printed plan is outdated before the ink even dries from the printer. So ongoing planning is a huge value. Talking about retirement, passing on your estate and legacy, managing the risks while alive, and reducing your tax burden. This can also include talking about efficient retirement income strategies, meaning where to draw your income from in retirement to meet your goals, as this isn't always as simple as just draw from your RSP or RIF. Now, often planning can be intertwined with wealth management, a term you hear all over the place in the financial services industry. So we see this being worth around 1% or more of value from Vanguard and Russell. And that leads to probably the largest value add, that being the behavioral coaching side of things. A real advisor provides tremendous value in helping clients to make better financial decisions and helping to avoid costly mistakes. This can include avoiding fad-type investments, staying invested during good times and bad, even when it doesn't feel good. Carl Richards, best known for his back-of-the-napkin type sketches, which many of my clients will recognize from being hung in my office over the years, and now in the background in our Zoom meetings. He's authored multiple books. One, Behavior Gap, had one of those sketches that I'll share in the episode notes if you visit our show page, that showed you, then your advisor, and on the other side of the advisor, the big mistake, which depicts just that, the advisor standing in between the client and the big mistake. And that in and of itself is a huge value add. Vanguard and Russell say this value can add up to be worth between 1.5% to 2% to clients, or even more. Okay, Scott, so let's rein this back in. Do I think most people can benefit from working with a real advisor? Meaning the advisor that focuses on providing these places where we see there is value? Yes. Yes, obviously I do. Do I think most people should work with a real advisor? Yeah, I do. Now, don't get me wrong, there are folks that don't need to work with an advisor. They're able to stay disciplined and in control of their finances. I will often say that if you can do it yourself, you probably will be well ahead as you save the cost of having an advisor involved. But I think from my experience in working with individuals and families, even after paying these costs, they will be further ahead. And like I stated before, most people need an advisor. Those that can do it themselves often will still reach out to get that second opinion just to make sure even they're doing it right on their own. But an advisor can bring you that value by helping you, create that plan, stick with the plan, and help you make those course corrections along the way. And then you just make sure that you're aware of all the different things because you just don't know what you don't know. So to answer our question, who needs an advisor? Well, anyone who is uncomfortable with making the day-to-day financial decisions or wants to hire someone to do the heavy lifting that can come with wealth management. Or anyone who feels they can benefit from an objective third party that can provide insights in determining when they can retire or paying less tax or reducing the fees they pay on their investments currently. As I've already said, there is value an advisor provides. You just need to find that real advisor that fits for you. And that's where the next couple of episodes will come in. Okay, I think that's it for today's episode. Be sure to subscribe and give us a review on your favorite podcast player. If you have questions or would like any retirement-related questions answered on future podcasts, please email us at info@awakenwealth.ca. You can also check out the Wake Up semi-monthly newsletter at the Awaken Wealth site. Again, awakenwealth.ca. Be sure to check back in 2 weeks for our next episode on advice that talks to what to look for in your search for a real financial advisor. Thanks again for joining us today, and I look forward to seeing you back for the next episode.
Thank you for listening to the Retire Ready podcast. To subscribe to this podcast or to learn more, please head on over to awakenwealth.ca/Retire Ready podcast. Investment services are provided through Awaken Investments of Align Capital Partners Incorporated, an approved trade name of Align Capital Partners Inc. /ACPI. Only investment-related products and services are offered through ACPI or Awaken Investments of ACPI and covered by the Canadian Investor Protection Fund. Tax planning, financial planning, and insurance services are provided through Awaken Wealth Management Limited. Awaken Wealth is an independent company separate and distinct from ACPI or Awaken Investments of ACPI. Awaken Wealth are not licensed tax professionals, and you should consult with your tax advisor before acting on any recommendations. Investments and investing strategy should be evaluated based on your own objectives. Listeners of this podcast should use your best judgment and consult a financial expert prior to making any investment decisions based on the information found in this podcast.